Hello, this is Jordan. This video is being recorded on the late evening of Thursday, January 12th, 2023. Thank you so much for joining me. In this video, I'm going to discuss and analyze one small but important developing macro signal for gold. And specifically, what I'm talking about is the 2-year yield and the potential for a real decline, a real accelerated decline. Much lower yields over the coming months. And we know that the Federal Reserve, coming up at the end of the month or very beginning of February, they're going to hike rates. And, it looks to me like that could be the last rate hike. And I'll tell you why. The reason is the Fed follows the 2-year yield. I mean, smart investors know that the Fed follows the market. And we actually saw this in the last cycle where I think the 2-year yield peaked, I want to say like a month before they did that last hike in December 2018. And I mean, after that last hike, I mean, the 2-year yield, it kept declining after that into 2019. I mean, it was clear that they were done after that. Remember, pretty quickly after that, they were getting ready to cut rates. I mean, that was only, 6 months between that, the last hike and the first cut. What we see here, the 2-year yield, we have the 50-day moving average there for both yields. And, I'm really more focused on the 2-year yield. And, what we see is it's been holding above that moving average. But look at what's happened recently. In December, it kind of fell below it, failed at it twice. And then we just saw another fail a week or so ago in recent days. And so the yield closed at 4.12. And if we see a real push down below 4% the very short term, it's going to be hard to make the case that interest rates haven't peaked. And there's potential measured downside target that it could come to 350. And, you have that kind of decline. We're not going to see. It would be really bizarre or just really unusual given everything that's happening to see this big bounce from 350 go all the way back up. So that's where we are. And by the way, I mean, you look at the 2-year yield started to get kind of toppy in October. I mean, when did, silver bottom? When was it? End of September. I mean, miners started to bottom a little bit after that. And then we know gold. I mean, gold was bottoming. Its ultimate low didn't come until November, but it was bottoming, after September. So that doesn't mean gold is always perfectly correlated to, falling short-term yields, but, in many cases it is. And so you get the point here. The 2-year yield is setting up for more of a potential decline. And that would signal that this is the last Fed rate hike. Now, obviously, the last hike is, it's obviously very bullish for precious metals. And you would think, oh, well, this is bullish for the stock market too. I mean, the Fed's going to, eventually they're going to have to pivot. But we've already had a really good rally in precious metals. Gold just hit resistance 1900 today. I mean, silver has been stalling for the last couple weeks. I mean, even in the last couple days, I don't think the miners have made a new high, whereas gold did. So we're seeing signs that precious metals are probably going to start softening, pausing, or correcting. And at the same time, we know the stock market is running into significant resistance. So the market has already anticipated and already discounted, for the most part, the end of the rate hiking cycle. So it's interesting, but that's what we could be setting up for in the next couple of weeks when the Fed executes this hike, which is very well could be the last hike. And after that, we could see stock market roll over again. Precious metals, miners specifically, they get hit initially. And I mean, it's kind of counterintuitive, but the fact is the market it's already discounted that for the most part. It's hard to say that it hasn't. So getting more into the 2-year yield, and I showed it in the last chart, the 50-day moving average is important. And Steve Seville, a great newsletter writer, he writes The Speculative Investor. He's especially great on gold macro and what really moves gold and gold's fundamentals, and not just the stuff that the average gold bug pundit talks about. And he talks about, I think he talks about the 50-day moving average on the 2-year yield as being very important. So that's where I got that from. Got to give credit to people who come up with things. But here, so if you look at those 3 sets of vertical lines, you have the blue and the black. The blue is the last rate hike in that cycle. The black is the first cut. Obviously, 2006 to 2007, a little bit different of a cycle, but the 2 circles there, those were big breakouts in gold when the Fed cut rates. That was the first rate cut of those cycles. And of course, they also cut rates in early 2001. It wasn't a breakout, but I mean, that was a pretty historic bottom in the sector. But look at the 2-year yield, and you can see what happens in between, especially in the 2000 to 2002 period. In 2019, again, the 06, 07, a little bit different. But so looking at 2000 to 2001, you can see the 2-year yield. I mean, it fell below the equivalent to the 50-day moving average, declining sharply. Fed had to stop. Fed had to cut rates. Gold against the S&P was turning up. And then we saw it again in 2019. Gold actually bottomed before that. And so you can see where we are now in 2023. Gold has bottomed before that. Gold against the S&P has already turned up. But the thing with the 2-year yield really plunging, or if it does plunge, then you're going to start to see the yield curve steepen. And that's, always a big key for gold. And, look at the very top there. That's the 2-year and the 10-year. And the steepening, I mean, we can see the steepening at the end of 2000, 2001. I mean, that was right about when that move took off, or a month or two after that. The market was at a much stronger position, 2006, 2007. Gold had bottomed before the yield curve really steepened, but as it started to steepen there in early 2007, gold was correcting but grinding higher. Then it had the huge breakout as the steepening in the curve continued. And, we can see the steepening in 2019. Gold had already broken out at that point. So, again, these indicators, not always a perfect relationship, but the key thing to think about is the 2-year yield and bond yields. And if we see them accelerate to the downside, that's probably going to coincide with the stock market selling off after this bear market rally. So that's something to watch for. And again, if the stock market sells off, the 2-year yield plunges, the Fed knows it's going to have to cut. And look, precious metal, I mean, miners, silver, they might get hit initially. They might pause for the next couple months. That's really nothing to worry about, because that's the macro setup that we want. We want the 2-year yield coming down. We want the stock market rolling over and going down. That's going to be the perfect setup. And, last thing, going back to, you can see those circles there, the end of 2007 and 2019, that's when the Fed executed its first rate hike in those cycles. What happened? Huge breakout. I mean, 2007, that was a very significant breakout, obviously. I think on that move, it made a new all-time high, got up to 1,000 in early 2008. And we know 2019, that breakout above 1375. I mean, that was a huge move. And so, why do I mention this? What are we getting at? If the 2-year yield continues to decline, it accelerates to the downside, stock market's probably rolling over, the Fed knows it's going to have to cut rates. When the Fed does its first rate cut, that's my rough prediction now. First rate cut of the Fed, that's when you're going to see gold break out to a new all-time high. That would be the biggest breakout in 50 years for gold. So that's why I'm getting so excited. But I know that's a lot on the 2-year yield. But if it keeps moving down, if the markets weaken and roll over, it's going to be really good for gold and precious metals. All right. Let me know what you think. Leave a comment, and I'll see you guys again in the next video.